across into dealing with Skype, she would not have heard because it wasn't recording the sound.
Yeah, I told her it. If you know about it, she reviewed.
Yeah, she should have been able to review half of it. But
Not
we sorted out. We sorted everything out. I reloaded a WebEx app, and it worked. It was okay, and as far as I'm aware, it was recording okay.
okay. And today we are going to earnings per share, yeah?
Right, you can tell me. It's really looking at the areas we didn't look at in the intro course. So I've got here earnings per share. Then I've got IFRS 5. Did we cover that on the intro course? I've not got it down here as ticked off for the intro course. So we're moving across to IFRS 5. Okay. Then I was going to be looking at intangibles impairment of assets, IS 3836. Okay.
Yes.
Did we do financial instruments? I think we did.
No.
We didn't do. Okay. In which case we'll cover financial instruments. I've got the wrong ticks here for another course. But we definitely covered income taxes, yeah?
Yes.
Deferred tax. I can remember that. Okay, so today we'll start with earnings per share, move into IFRS 5, then we do intangibles impairments, or maybe we'll do IFRS 9 first. Then we'll look at intangibles, and if we have time, we'll move on to impairment.
I have also questions about. I'm really concerned about, do we have enough time to practice to have all this, as far as I understood, to be prepared, to be armed for the examination, we have to do all this financial reporting exam kit.
Yes.
So
well,
it will
as
be
much as
enough, 2 weeks.
possible. As much as possible. Okay, so what you want to concentrate on will be the long form questions on consolidations. Where review consolidations tomorrow. Okay. So we'll look at the consolidations tomorrow, and we'll do some questions from that. Then we've got one more left. One more, just to bring up diary. We've got one more left, which will be on Sunday. Yeah, the 24th. Yes. Which I'll get that set up because I'm up in Moscow on Thursday. So we'll do that on the 24th. So we'll finish off consolidations on the 24th. Okay, and then we'll look at. Sorry, I've got so many things in front of me with messages coming in. Fine, and then we'll look at dealing with preparation of financial statements. Mm-hmm. Okay, which we can run through a typical type of question on that, which is really the basics of preparing a set of financial statements, plus all the adjustments from things that you know, like deferred tax or earnings per share or provisions or leases. So all little calculations from all of the IFRSs. One thing I can ask for you, but let me just check. I don't think. Yuri, can you hear me?
I do hear you.
Both of you can hear me. Yes.
Yes.
Right, I've got Yuri K and Yuri User. Excellent. Good. Okay. Right. Just explaining what the plan. Did you hear about the plan? What we're going to be doing tonight? Yeah.
No, I guess Yuri came a little bit later. We were talking about consolidations.
Okay, fine. Yeah. Plan for today is to tidy up with things we haven't covered at all, including the intro sessions. So IAS 33 earnings per share. Then we're moving to look at IFRS 5. Okay. Then I've got intangibles, impairment, and IFRS 9. Probably do IFRS 9 before intangibles and impairments, because that's always going to be fun. Looking at that. Tomorrow we'll be looking at consolidations, and then I said for the session that we got left, the evening we got left, that's now moved to the 24th, as we discussed. We'll start that normal time, 6 o'clock. I'm up in Moscow from Thursday, so I'll be on Moscow time, 1 hour ahead of you guys. So we do that at 6 o'clock your time on the 24th. Now, question to ask you. When do you want to do the mock exam? Now,
We have to do it all together in one time, or how will it be?
It's a mock. You need to do it within the 3¼ hours.
We can choose whatever we want time and
yeah. The original option would have been that if we'd had the webinar on the 22nd, which unfortunately it's crowded out. You would have had access to the online for the weekend 23-24. Okay, now that can still go, even though we're doing the webinar on the 24th. That won't be an issue. We can open it up, and you can access on the 23rd and work it through. But because it's electronic, you do have to do it in the time that's allowed. You can't sort of come out, leave it, and go back in again. Once you come out, it closes down, and that's the end of your session for that. The other alternative is that we will give you access from the 25th, Monday. Yep. But that means that you will have to do the exam 3 hours, 3¼ hours in the evening. Okay.
In the evening or during the day?
Or during the day. If you're taking time off that week, you can do it anytime you like. Do it 4 o'clock in the morning if you really wanted to. Doesn't matter. It's a 24/7. Once you've gone in, you started it. You need to go for 3 hours, 3¼ hours to complete it. Yeah. Okay. It's going to come back to me. So I'm going to be having a look at it and assessing it. Okay, marking it. Now I'm just looking at my timetable. So as long as I've got it on the 29th, on the Friday, I will mark it on the Saturday, the 30th. Okay. Yep. Now, I'd like to give you feedback on it. So we can do another webinar either on Saturday or Sunday. It's up to you guys as to when you're planning to do the mock exam.
Saturday or Sunday, 30th of November or 1st
30th of November or the 1st of December.
For me, it will be preferable, even will be preferable 1st of December, because all that week I will be on a business trip.
Aha.
So all day long I will be on a conference, on meetings, so I don't even know if I will have 4 hours to take an exam.
All right, in which case you can do it on the 30th.
30th, I'm going back to Cyprus, but I think I will come. I can do it in the evening. I
If you
can
can
do
do
it
it in
in
the
the
evening,
evening
send
13th.
it to me as soon as you've finished it. Yep. Then I can mark it and we can have the webinar Sunday at 5 o'clock, if you like. 1st December at 5 o'clock. Okay?
Okay.
Is that okay for both of you? 1st December, 5 o'clock.
Yes, it's okay.
All right. So long as I've got everything that I can mark for 12th. Okay. So that will be the review. Good. So we're opening it up on for the 30th. Once we've finished. Sorry, come back again. Once we finished the webinar on 24th, yeah, it will be opened on the 25th. You can then access the exam, and as long as it's done and sent to me by midday on the Sunday, the 1st, okay, that will give me time to be able to mark it.
It will be
Okay for you
opened
guys?
in the morning 13th.
Sorry?
It will be open in the morning 13th or
So it will be open in the morning of the 25th.
25th. Okay.
Monday
Okay.
the 25th. Yeah.
Okay. 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 Good.
You'll get an email from Oksana.
Okay.
That
Thank you.
it's open for you. Okay. And it should be open. You should be able to keep it open for the week. I'll explain that. Now, Oksana's typing something to me. She's on. You guys can hear me, so I think we can. Okay, yeah, it will be. You'll get an email from a guy called Alexei Korolov.
Mm-hmm.
Okay, he will open that up. Is that okay?
Yes.
Right, good. Let's get the recording going. Oh, that what's happened. My feedback. I don't want to give feedback. Right. It is recording. All right, good. We're in. It's been recording for some time. Excellent. Right, so I sorted that out. We'll now move on to have a good look at and Sorry, I'm just organising. Good. IS 14, earnings per share. Typically, you could easily get this in the context of a Section A or Section B question. And you could also get it in the context of Section C, where it is probably going to be a case that you will be preparing a set of financial statements, and it will be an adjustment, well, not so much an adjustment, it will be a separate disclosure calculation that you will have to make. So it's virtually certain that it's going to be there. One thing to bear in mind about earnings per share, the examiner, okay, can ask you to do it, but in practice, earnings per share is only for listed companies. It's a little bit strange that if you're a listed company, you stop being a listed company, you delist, you've still then got to carry on disclosing earnings per share. It's just one of those strange things. If you're lucky, you'll just get a straightforward calculation of the earnings per share, which will be the earnings attributable to shareholders after tax, bottom line, with the number of shares that have been in issue, and there would have been no share issues or bonus issues or rights issues during the course of the year, or any market value issues during the course of that. If you're very lucky, because that's the most easiest thing to do. So what could happen is that you increase the company issues normal shares at market value, in which case you have to play around with the timing and the weighting of that. Then you are going to have a bonus issue. Bonus issue involves no cash whatsoever, and the assumption is that it will be as if the shares have been issued from when the shares were first issued, way back when the company incorporated and issued shares. Then we have a rights issue. Typically, the rights issue is not free. It's first choice on having the rights will be the current shareholders, that they can buy a rights issue, and normally it will be at a lower price than the market issue. The reason for that is to encourage the current shareholders to buy the shares, so there'll be a discount on that. That basically means that in comparison with the full market issue, there will be an element of a bonus issue. In other words, what is paid is cash, but that will be below the market value, so there's a bonus element. So you're getting you're getting a share at full market value, but you're only paying a little bit for it. So the other comes free in the concept of being a bonus. We have to work out that separately. And the other fun and games the examiner is going to get up to will be looking at diluted earnings per share. So that may be where you have convertible debt. We'll look at the calculations on that when we look at financial instruments. Or you could have share options. In other words, at some stage in the future, then shares will be issued. So to give the full transparency to the shareholders like to know what the impact of the convertible debt or the share options that may kick in 5 years' time, what will be the impact of that on the current profits? In other words, basically it's going to be that the profit per share, the earnings per share will be lower, because if it's convertible debt and share options, there'll be more shares in issue. Okay, so that's the look. That's the look at what we have to deal with. First thing, the basic earnings per share. That's simple. What are the earnings? What are the number of shares? So the earnings will always be the profit available to ordinary shareholders, which is going to be after tax. Then we have the number of shares that are in issue, and that's the so-called weighted average of the number of shares. Now, if there have been no shares issued during the year, so the shares opening and closing are the same, the weighted average is 1. There's going to be no adjustment. If there is a weighted average, then you have to consider when were the shares issued. So using the weighted average table, well, that's in 1.3. If they're issued at full market value, then what you have to do is look at the number of shares in issue at the beginning of the year. When were the shares issued? So if the shares were issued, for example, on the 1st of April, then we've got a 31st December year end. If they're issued on the 1st of April, then we have January, February, March, 3 months. So the fraction will be 3. The remaining fraction will be 9. 3 plus 9 equals 12. Okay, so number of shares issued, forward, should I say, multiplied by the fraction, 3/12, and that will give you the bonus fraction. Add them together, and that's going to give you the weighted average. Then the number of shares that are issued at the 1st of April, and that will give you the total shares that will be in issue for 9 months, 9/12. That will give you the straight weighted average for the 9/12. Add it together, that will give you the weighted average for the entire year. All right, we'll look at an example of working through that in a few seconds. If there is a bonus issue, as I said, you assume that the bonus issue was issued with the original shares. So the bonus issue is always deemed, doesn't matter when it took place, always deemed to have happened on the first day of the year for the calculation. But because it's a bonus issue, then the second deemed element is that they have been in issue forever, in which case that's going to impact narratives and earnings per share previous years. We'll look at how we deal with that in a minute. The rights issue, again, we're going to be using the weighted average table, but we're going to have this rights issue bonus fraction, often referred to as a TERPS. But I'll take you through that rather than try to explain it. You can see it, and then you know how it can be dealt with. Okay. So I'll actually go through the examples. Just like to read through that. We've got to calculate the earnings per share for the 31st of December. Right, hopefully you've done that. We've got 6,000 ordinary shares on the 1st of January, so that 6,000 automatically comes down to the shares brought forward. That 6,000 will have been in issue for 3 months, because on the 1st of April, 1,500 additional shares at the full market value were issued. So we'll take 3/12 of that 6,000, and that is going to give us fraction for the year. So 1,500 shares were effective for the first 3 months. Then we have an issue of 1,500 shares. That's issued at full market value. So we get the full cash coming in. That 1,500, we just add to the 6,000. So the closing balance will be 7,500. So that will be the balance on the 31st of the 12th, X3. Okay, but that 7,500 will have been in issue for 9 months. Okay, so that will give us a weighted average of 5,625. That will give you a total weighted average of shares for the year of 7,125. We are told the market value of the shares on the 31st December were 1,200. Sorry, the earnings were 1,200. Therefore, the earnings per share will be the 1,200 earnings divided by the weighted average of those shares. Okay, so that comes as the weighted average here, and the 1,200 give you the earnings per share of 16.8 cents. Okay, always remember to include the cents. It's part of the equation. Okay, because if you just put 16.8, then that might be taken as $16.8, which it might be, but of course everything else is then going to have to be multiplied up by 100 to give you the $16.8. So always put the cents figure in. Okay, any question on that? As I said, that is fairly straightforward.
Yes, it's okay.
Good. Not lost you. Excellent. Right. Then we have a bonus issue. Now remember, with a bonus issue, no cash. Okay. But you have to assume that they would have been in issue for the whole year. Bonus issue. You know the concept of the bonus issue, that normally it will be transferred from a share premium account. So you'll debit the share premium account with the nominal shares and credit the share capital with the nominal value of the shares. Doesn't matter what the market value or anything, you're not interested, you're not paying anything. You're just transferring from revaluation reserve, from the share premium account to the share capital account. If there's no share premium account, and you appreciate that the share premium comes from previous share issues where the share price, the market value or the share price of the issued shares greater than the nominal value. So the difference be taken to the share premium account. $6 issued, $1 nominal, $5 will go to the share premium, $1 will go to the share capital. Okay, if we don't have a share capital, don't have a share premium account, then you would normally take it from other reserves account. Apart from the revaluation reserve, you cannot use the revaluation reserve. That's for revalued assets only. So at this level, the next reserve that would be used is likely to be the profit and loss account, the accumulated profits. So you debit there and transfer those up to the share. Okay, so you're going to work out the bonus fraction by looking at the number of shares divided by the old number of shares. Okay, so if we just work through that, you can see how this will work. Robert, it's the same as example 1. We've got 6,000 on the 1st of January. Here we issued 1,500 shares in a 1-for-4 bonus. Okay, so the 1,500 shares, where does that one come from? Well, if it's a 1-for-4, we get 1 share for every 4 that has been held. So 6,000 divided by 4 will give you the 1,500 shares to issue. Okay, a 1-for-4 bonus, 1 for every 4. The earnings for the year were 1,200. Okay, so that was on the 1st of April. Here we have 6,000 old shares forward, bonus issue of 1,500, a 7,500 total. As this is a bonus, then we do 7,500 for the entire year. Okay, it doesn't, even if these were issued on the last day, the 31st of December, you'd still have exactly the same. The fraction would still be in terms of the whole year. They're deemed to be held for the whole year. You have 7,500 shares weighted average. Therefore, you will have 15 cents per share, 1,200 earnings divided by the new 7,500, as if the bonus shares had been in issue from the very first day. Okay, so what do we have in the first example? We had 16.8 cents. Okay, because the weighted average is lower because some of those shares at market value were issued on the 1st of April. As a bonus issue, they're deemed to have been issued for the entire year. Questions on that, okay?
Yes.
All right, so we've got a bonus fraction here of 1/4. This is 1-for-4. Good. Rights issue. Now, if we're dealing with the rights issue, then you're going to sell at slightly less than the market value. So you're getting part of the share at the rights issue's price. Remaining part of the share is a bonus. You're not paying for it. Okay, so you're getting something cheaper than the market value. Therefore, effectively, it's a bonus issue. That bonus issue also means that that would have been in issue from the very first share issues. So we need to work out the rights issue bonus fraction. And you'll need to remember this, the actual market price divided by the TERP, the theoretical X rights price, which basically means that as time goes on, the share price in theory will increase because there will be a dividend that's going to be paid. So cumulatively, if you leave buying a share till the day before a dividend is declared, theory, then the price of that share will include the dividend that you are going to receive. The value of the share will increase to reflect the potential dividend, in theory. Okay, so the theoretical X rights price basically means what would it be? What would have been the price if there had been no share, no rights taken in? That's referred to as the TERP. Example 3. Same again, we've got 6,000 ordinary shares, 1st of January. We issued 1 for 4 again, but this time the rights issue was 250 when the market price was 4. So that is quite a heavy discount. Doesn't matter. Don't argue about that. Got 250 rights price, market share of $4. So we're going to pay 250, and we're going to get an extra 150. Brings up to the market of $4. That 150 effectively is a form of a bonus. It's not quite as easy to work that out. The earnings are still 1,200. All right, so we hold 4 shares. At the time of the bonus issue, the price per share was $4, okay, which will give you a total value of 16. We issue the rights at 250, so effectively the total value that you hold is now 1850. Okay, 4 shares at the share price, the fair value, 1 share at the additional 250 paid for the share. Therefore, you now have 5 shares valued at 1850. So the X rights price is going to be related in terms of the 5 and the 1850. So although it's referred to as the theoretical X rights price, effectively what is the theoretical price per share at the end of the rights action. Another way of looking at it. But you need to remember what TERP is and how to calculate it. Straightforward. Okay, so we just add up the shares, calculate the total value, and divide the total value by the number of shares. But now I've got to work out the weighted average share because we have a rights issue. If the shares have been issued at market value, then the weighted average is as we saw in the first calculation. But we're now combining these two elements together in terms of the bonus issue and standard full price issue. Same approach. We have the number of shares bought forward. How long have we held those shares? Okay, we've had them for 3 months, but now we have to multiply that by the rights issue bonus fraction. Same idea again in terms of the rights, not the rights issue, same idea in terms of the bonus fraction, but it's a rights issue bonus fraction. And that's calculated here. The actual market price per share, which in this case was 4, divided by the theoretical X rights price. And that was 370. Okay, so we get the 4 divided by 370. So that will give you a weighted average of 1,620. Okay. Then the rights issue, the actual shares you got 1,500. Got 7,500 at 9 months, 5625. So we get total weighted average of 7,207. Earnings were 1,200 divided by the weighted average, take into account rights issue bonus fraction, and that will give you 16.6 cents. New Yep. Okay, just a second. Okay, nothing. It is good. Any questions?
No.
Good. You're still. Yep. Good. Right. Now, if we've got a bonus issue, the bonus issue doesn't matter when it was, end of the year, doesn't matter. Be deemed to be in existence from the very first day when the company was. Right. So, how are you going to change the comparatives? Well, that's easy. If you know what the bonus fraction is and you calculate it, then you just do the inverse of the bonus fraction. All right, so we got 6,000 ordinary shares, 1st of January, 1,000 in a 1-for-4 bonus issue. Okay, the earnings per share for the previous year was 18 cents. The bonus fraction is 1-for-4. So we had 4, now we've got 5, so we've increased by a quarter, so it's 5/4. That's the bonus issue. What we had, what we got. We now got 5/4. So we just invert that to 4/5, and that will then give us 14.4 cents. So the previous year's comparative, 14.4 cents. If there's a 10-year summary of the earnings per share, then you do exactly the same each of the 10 years. So whenever earnings per share is shown, doesn't matter 1 year, 5 years, 10 years, whatever, then you need to work out the inverted earnings per share as if the bonus had always been in ish. What about the rights issue? Well, this now gets a little bit more fun because this is one thing that a lot of people, students will forget about. If you've got a rights issue, then you're going to have a theoretical bonus element attached to it, the bonus element. So back to the same example, we issued 1,000, 1-for-4 rights issue, market price was $4, the market price was $2.50, the earnings per share was 18 cents. Now, if we go back to the previous example, then the rights issue bonus fraction was 4/3.7. To this one, where do we end up with that? Okay, that's the rights issue. So the bonus rights issue fraction is 4/3.7. Okay, which is the original holding of 4 divided by 3.7, which is the theoretical X rights price. That will give you the rights issue bonus fraction. Okay, just make sure that you know how to deal with that. To do a TERP calculation, remember to do that. So that will mean that for the rights issue, the restated earnings per share will be the 18 cents. Previous earnings per share for December X2 multiplied by the inverse of the rights issue bonus fraction. Okay, which of course could also be 18 cents divided by the rights issue bonus. You'll get the same result. All right, so 16.6 cents. So anything in terms of dealing with earnings per share and the potential changes, share issues, rights issue and bonus issue. Yep, you guys still there? Make a noise, breathe somewhere.
Fine.
Yes, we are.
Yes. Hit the desk, clap, whatever. Okay, fine. Now, what's going to happen with diluting issues? Remember what I said, that if there is a potential future issue of shares, and that's with a convertible bond or option shares, then it's a requirement that you have to work out what the earnings per share would be if those shares had always been in issue. Okay, so convertible bond. Robert's got 6,000 ordinary shares up to in terms of 20x3 throughout the entire year. At that date, he also issued 5,000 convertible loan stock with an effective interest of 10%. The income tax is 30%. Why are we interested in income tax? Because debt is going to have consequence. Okay, because the interest on the debt going as part of the financing of costs, it will be subject to taxation, tax relief. The loan is convertible into ordinary shares on the basis of 60 shares per $100 of loan. Earnings were 1,200. Now, a couple of things to remember here. One, when the loan stock has been converted, then your share capital will increase. Okay? And if your share capital increases, your debt disappears. You don't have debt anymore. So if you don't have any debt anymore, then you're not going to have any interest to pay. So your profits will go up. So the retained earnings will be increased. Okay? But it will be increased not by the total interest, but by the net amount after the tax. Remember, you're dealing with profit to the shareholders, which is after tax. So, looking at this, basic number of shares 6,000. What would be the number of shares if they were converted? Well, 60 shares for $100, $5,000 divided by 100, multiplied by 60, 3,000. So if the conversion had occurred, there would be 9,000 shares in issue. So we have a basic earnings of 1,200. Because we've not got the debt anymore, then we're not going going to be charged with the interest, 500. So our profit would be 1,700. But that 500 would be subject to tax at 30%. So the actual change is only going to be 350. So that will be the net cost after tax relief. Okay, so the adjusted profit is going to be 1,550. So that will give you diluted earnings per share of 1,550 divided by 9,000, 17.2 pence. That's if they are converted. They might not be converted. Work on the assumption of what we got. If these did go through, then what would be the maximum diluted earnings? Okay, when you get up to strategic business, then it's going to be more fun. Okay, it gets a little bit more interesting, higher level. Anyway, let's now have a look at another element, options. Diluted earnings per share, where we have options rather than debt. So we've got 6,000 ordinary shares, 31st December, okay. We issued 2,000 share options. Exercisable at $1.20 per ordinary share. The average fair value during the year was $150. Clearly, whoever's got the share options is going to make a profit. 1,200. So we need to work out the diluted earnings per share. That profit is the bonus element of the options. They got 120, they're going to get 150. So effectively, they're getting a bonus of 30 cents. But that is 30 cents compared with the fair value. So that will give you the percentage over the fair value at 2,000 share options. So effectively, they're getting an additional 400 shares through the option. So in that case, they will have 6,000 ordinary shares plus the effective additional shares of 400. And then that will give 18.8 cents per share. Right. Any questions on that little lot? Good, good. I got questions for you. Excellent. Earnings per share. All right, let's start with number 119. Question 119. So let me switch them. Good, and I want. Starfish. Work through with Garfish. again, sorry?
79.8.
78. Interesting. There's a 9 there, 8 there, not 79.8. Okay, right, let's work it through and just go through where you've miscalculated it. Now, you've got to bear in mind that where you're dealing with Section A or Section B, you get 0 marks. If you're dealing with this calculation, if this came up in Section C, there's 2 or 3 marks available, provided you show on the computer side of it how you actually made that calculation. And if there's 2 or 3 marks available, you may only lose half a mark or 1 mark at the most. Okay, so that is going to be critical. Okay. What are we dealing with? We have 3 million in had profits 3 million at the end of the year. On the 1st of January, they had 2.4 million shares in issue. On the 1st of April, they made a 1-for-2 rights issue when the market price of Garfish shares was $2. So if we're dealing with a rights issue, then we've got to start working out what is the theoretical X rights price. That will then give us the rights fraction. All right, so calculation of the TERP. Okay, use the format you're familiar with. What shares? What are we dealing with? It's a 1-for-2 rights issue.
2 shares with the price 2 and 1 share with the price 1.4.
So we've got 2 shares at 2, 4. Okay, and we've got 1 share at 140. Yep. 40. Therefore, effectively, you've got 540, and you've got 3 shares at that value, right? So 3 shares at what price to give you 540? 180. Okay, so in terms of the table I've done here, you can see how you're working this out. It's a bit like working out weighted average of inventory in a way. All right, so the theoretical X-right price is 180. Therefore, what is the rights fraction? It's going to be the original $2 over the TERP, the 180. Over 180. That will give you the rights fraction. And let me just come over here, because now we need to work out what is going to be the weighted average number of shares. So at the beginning, on the 1st of January, how many shares do we have? We have 2,400,000. How many months did we have the 2,400,000 for? 3 months. So we take 3/12 of that. And then we have to do the bonus fraction. Okay, what's the bonus fraction? The rights fraction. 2 over 1.8. Include that?
I calculated wrongly the TERP.
Ah, okay.
I calculated the ordinary price 2 with not 2 shares but 2 just. That's why my TERP was 3.4 but not 5.4.
Okay, all right. So that's what we got. So on the 1st of April, you had 3,600,000 shares. Okay, because you had the bonus share coming in, 1-for-2. Let's just see. Let's put that in. You had an extra 1. 1,200,000 coming in, which will then give you 3,600,000. Okay, and you multiply that for the period of 9 months, that will give you 2,700,000, which is then going to give you 3,366,667. Too many fractions flying around here. Okay, so what's going to be the earnings per share? Well, what's the total earnings? That was 3 million. Yep. Divided by the 3,366,667. That will give you the 89.1 cents. Okay, good. You know the slip you got. It's a good idea to make your slips at this stage and learn from them. Okay, so you're not going to repeat that slip in the exam, hopefully. 120. What do you make for that?
A.
You think it's going to be A?
The 7.
So yeah, so that's coming up at 47 shares. You want me to go through that? You're okay with that? Let's just go through. Oh, yep, quick.
Forward.
Pick it through. Okay, just make sure you get the right order. Take it step by step. Okay, do first. On the 1st of January, we've got 3 million ordinary shares. Then on the 1st of June, there's a 1 for 3 bonus issue. All right, so let's put that on the 1st of January. How many shares do we have? We had 3 million. Then what happened on the 1st of June? Well, on the 1st of June, we had a bonus issue. Bonus issue was 1 for 3. Yep. So we have another 1 million shares coming in. So on the 1st of June, we've got 4 million shares. However, with that point, we need to work out what is going to be the fraction year and the bonus fraction. So the year and the bonus. What's the year fraction? Well, up to June, that will be 5 months. So that was in operation for 5/12. Okay. What's going to be the bonus fraction? 1/3 bonus issue, which will give you a 4/3 bonus fraction. So therefore, the weighted average is 1,667. Okay, so that's dealt with the 3 million opening and the 1 million issued on the 1st of June. All right, what's happening next? On the 30th of September, issued, we'll get the right, let's get the right pen in. On the 3rd of September, we issued a further 1 million at a full market price. Okay, so we got no rights issue. We got no additional, there's not a second rights issue coming in, okay? And there's no other bonus issues or anything else like that. Fine, no rights issues coming in. It's just a full price. So what's going to happen is we issued a further 1 million shares on the 30th of September. We issued further 1 million shares. That will give us a closing of 5 million. So the 5 million will be the closing on the 30th of 12th. All right, but the year fraction, what's going to be the year fraction for the 4 million? It'll be 4/12, 4 million. Okay, which is the opening of 3 plus bonus issue. Okay, so we've got June, July, August, September. 4/12. What's the bonus fraction? There isn't a bonus fraction because it was at the full value. So there we've got 1, 3, 3, 3, 3, 3, 3. Then for the remaining period, October, November, December, we got 5 million. Again, no bonus fraction, nothing's happened. So 5 million at 3/12. 1250 4250. That will give you the weighted average, and therefore 2 million divided by 4,250,000 is going to give you the 47.1 cents. Question: what if that issue of 1 million at the 30th of September had been a rights issue? What then?
Then we will receive bonus.
Then you're going to have to work out what the bonus element is. Okay, you all right with that? If it had been a rights issue, then there would be a bonus element. Put bonus element rights there, yeah? Okay, then what? Because the bonus issue is deemed to be from the very first day that shares were issued, then would also have to incorporate that in terms of the first 3 million plus the 1 million shares that was issued at a bonus. So another bonus element coming in there, work out what the weighted average shares will be. That's tricky. So because it was because it was at the ordinary share price market value, there's no bonus element. But if there was a bonus element coming in, then you'd have to give it back all the way through.
But also we have to give it back not only to the 1st of January, but to the number of shares of 4 million shares, the 1st of June as well.
Yeah, the 4 million, the opening 3 million, and the 1 million that you're dealing with. Yeah, for the first 5/12. Yep. So you take it all the way back. Yeah, you're right in what you said. Okay, so with the 4/3, but the first bonus, because you're taking it back, then the first bonus you're hitting all of the 4 million, the 3 million, and the 1 million. Yeah, working on the way back. Then because you've got, if there was a second bonus element, then you also include that within your calculation in terms of 4/3 multiplied by the additional bonus element. And then if you're doing comparative would then be 3/4 multiplied by 1/the bonus rights element. Well, okay, so that would be the comparative figure. You need to work out the new comparative earnings per share. So as I said, just do it in the order, but always remember that the bonus elements go back. So do it to everything that's happened before. Okay. All right. Do 1, 2, 2. We'll do 1, 2, 2. Then we take a break. 1, 2, 2. You're dealing here with a convertible bond. It will give you a working with a convertible bond. That should be enough. Yeah, that looks like I've gotten very few more ticks coming up. All right, 1, 2, 2. Tell me what you think it is, A, B, C, or D.
E.
You believe D. Okay, good. Yeah, roll with that. I think 146. Good. So quick roll through. What are we dealing with? We got earnings, basic earnings, 10,500,000. That's okay. Earnings per share, 10,500,000. What's the interest that we saved? We've got 2.5 million at 8%. Yep. So we're saving interest of 200,000. So we can add that back. What's the tax? Tax rate is at 8%. So we've got 200,000 coming in at 28%. Not 8%. So we've got 56,000. So the net is going to be 144,000. So 144,000 onto 10,500,000 is 10 million. Or that's the adjusted earnings. What's the shares? Shares for the basic EPS was 6 million. All right, but what will be the issue on conversion? Well, 2 million.
1,500,000.
Yeah, divided by 100 at 50. All right, and this. Okay, so that will give you, I think you said 1,200,000. Calculate that out. That will then give you 7 million. Up is what you got there. So diluted earnings per share, 146.8. Excellent, good. I think that's everything. Just 1 second. Have a quick look, please. Very quickly, there's another 1, 2, 3 I'll let you do for home, where we're going to be dealing with options on that basis, okay? Then we've got some typical wordy questions. There's a tool of foreign not to be removed. Then we've got a mix and match style question. Then we've got wordy as well. So work through all of these until you're happy with the calculations and the wordy elements. Moving on, have a look at 301. Question 301. Find on page 8. I'll let you work through that in terms of home study, but this is a typical section B style question. So we've got earnings per share, diluted earnings per share, basic earnings per share. We've got Barstead, Colbert, and Dunstan. So we've got 3 different companies mixed up in there to work things out. And then a little mix and match or tick the element. Which 3 companies will have to restate the prior year comparative earnings? Figure will tell me without even looking at the narrative what would determine if any of those companies have to restate the prior year comparative earnings. So one word. Bonus. So if one of them's made a bonus issue, the comparative needs to be restated. Yep. One of them has made a rights issue, then there would be a bonus element in the rights issue, have to be restated. One of them made an issue at market price, then the comparative would not need to be restated. Okay, then 305, got a couple of statements and you need to tick which is correct and which is incorrect. All right, you tell me very quickly, what's the answer? Statement 1 or statement 2? Both. Statement 2 is correct, yeah? Statement 1?
No, it is not a forecast about the future.
Yeah, okay, so that's correct and that's incorrect. Good. That's nice and easy. That comes up. That will be the first question you'd answer because you've got 2 marks in the space of time it takes you. Good. Okay, let's take a break for coffee. Is that right? Yeah, because we're
Okay.
going for an hour and a half. Let's take a break for coffee. After that, I think we'll hit IFRS 9. That might actually take up the remaining time because that's going to be an interesting one. Good. IFRS 9 after the coffee break. IS 32. Financial instruments. Excellent. Right. Let's see if Anna's awake. Guys. Yeah?
Hello, I'm here.
Back. Good. Thank you very much. Oh, what did I say? Financial reporting. Okay, along with things like tax, revenue, IFRS 9 does create problems, particularly in the case of classifying, dealing with financial liability. There will be a bit of a learning element to do it in terms of exactly that, of being able to correctly measurement. So financial liabilities, what cost, dealing with compound, another area where wrong wrong in terms of calculation of the amortized basis. And financial assets as a debt instrument or an equity. So a little bit of learning, just make sure you know what a financial instrument is, gives rise to a financial asset of one entity and a financial liability of equity instrument of another. So that reflects the good old debit and credits, the counterparty element. Financial asset by definition is cash. Don't get going with that one. But it's also going to be an equity instrument of another entity. Investment. It will be a contractual right to receive cash or another financial asset. In that case, it could be debt receivables. Contractual right to exchange a financial asset or a liability on favorable terms, meaning that when you've netted everything off and exchanged it, you will then have an asset. You'll be generating future economic benefit. Okay, so the financial liability is the reverse of this. You're going to deliver cash or another financial asset, contractual obligation, so that could be a payable, or to exchange financial assets or liabilities on unfavorable terms. You end up with a liability. Dealing with debt or equity, then basically there's going to be a number of examples that will come up. So if you're dealing with the dividends, for example, dividends here, treatment of interest and dividends into the financial instrument, also have to follow the treatment of the instrument itself. So dividends paid in respect of shares classified as a liability are charged as a finance cost through profit and loss. All right, can you give me an example of what that's talking about? What will be a share? What's another name for a share classified as a liability? Preferred shares. So preferred shares, preference shares legally could be classified as a equity, but when you look at the basis of the preference shares, it's not equity, it's a debt. Even if the preference share has a dividend, although that dividend is usually classified as interest. So looking at the nature of the instrument, you will need to consider the substance as to whether or not it's going to be a debt or equity. Preference shares will be the only ones that you're likely to come across at this level. Everybody still there?
Yes.
Good. Right. So here we've got preference shares. As soon as you see preference shares, usually they're going to be redeemed. Okay, so if they're redeemed, they're unlikely to be a share. Okay, they've got 30 million to repay and pay 8% dividend each year, whereas the dividend for equity shares will be variable. In some cases, it will be zero. So in that case, this is going to be a debt arrangement liability rather than equity. Financial liabilities, the easier one to deal with, amortized cost or at fair value through profit or loss. Okay, the amortized cost in terms of the financial liability would basically be you're going to be holding that financial liability and paying back over a period of time. Fair value through profit and loss be where they are being for trading or they are derivatives. Forget derivatives at this level. Do you worry about that when you'll deal with the SBR? Okay, so if you're trading regular buying and selling of financial liabilities, then the basic treatment is going to be through profit and loss. So you revalue at the fair value, then transfer any gain or loss through the profit and loss. Amortized cost. Remember this one. Initially recognized at the fair value. Everything is going to be recognized at fair value. After that, okay, it can change. So usually the process received less any transaction costs. Then they're going to be measured at amortized cost. You'll be given a specific rate in connection with the instrument, but you're also going to be told what the effective rate would be. You charge the profit and loss with the effective rate, and it's added to the carrying amount of the liability. Any cash payments are then deducted from the carrying amount of the liability. So it's just a technique that you need to be able to apply to the scenario that you are given. The examiner is going to tell you what the effective rate will be. Okay. You can use a table for working out what the carrying amount of the liability is going to be at the end. All right. And if you're familiar with leasing, then certain similar types of things would happen with leasing in terms of working out what the payment would be, what the short-term and long-term liabilities would. So in the first year of the liability, we have an initial value. You're then going to be charged interest using the effective rate of interest, so the liability will increase. Then you will pay the cash, which will include an element of the interest and the liability, and you have a closing amount. Okay, if we're looking at the cash, then this is where students are going to get mixed up, because cash payment will be based on the par value, usually the nominal value, and the coupon rate of interest. You might have a 6% coupon rate of interest, but the effective interest could be 8%. Okay, so make sure you understand the difference between the two, and the cash is going to be the coupon rate, i.e. the rate of interest that's built into the debt. Okay, this is in the sense of amortized cash liability, but on the other side of the coin, then somebody's going to be receiving this. The basis will work the same. So 5% loan note is issued for 5,000. What do we mean by 5%? What's another name for calling that?
Nominal rate.
Yeah, or the coupon rate. Okay, that would be the coupon rate. The loan is redeemable after 3 years, and there's a premium of 487. So how much are we going to be paying back 3 years' time? Two together. you're going to be paying 5,487. So you borrow 5,000, you pay back 5,487. 487 is the effective interest. And that then be 8%. So basically taking 5,000, unraveling over 3 years, and you're paying 5% per annum, including the 487 premium, will give you an effective rate of 8%. Also, interest is paid annually in arrears. It could be different if it was paid in advance, but most of the time you're going to be dealing here with being paid in arrears. In other words, it's at the end of the period. So in the first year, we have an opening balance of 5,000 on the 1st of January. Because we're paying interest at the end of the period, okay, then we're going to work out on 8% nominal rate. Okay. And then we pay the interest cash at 5% of 5,000. Notice here it's telling you that the loan of 5,000 and the premium is being paid back at the end of the 3-year period. So the only payment going out will be the interest payment. That calculates to become, in terms of the statement of financial position, a liability of 5,150. You take that, interest rate of 412, 250, 5312, opening 5312, interest at 8%, 425, interest paid 250, and therefore that will give you a final liability to pay to settle of 5,487. Okay, any questions?
No.
All right, another quick example here. Entity issues a 4% loan note. That will be the coupon rate. Nominal value of 20 million. The loan notes are issued at a discount of 2.5, and 534 of issue counts are incurred. The loan notes will be repayable at a premium of 10% after 5 years. The effective interest rate, taking into account that 10%, is 7%, and they're paid annually in arrears. So what are you going to record as a financial liability when the loan notes are first issued? And what will be the position after the first year? Okay, remember that we told you that any issue costs are deducted from the proceeds. So here we have a nominal value of 20 million, nominal proceeds. However, there's a 2.5% discount, so the actual proceeds are 19,500. Then we got the issue cost of 534 coming off. So the actual net proceeds are 18,966. That 18,966 has to increase over the, was it a 5-year period? Over the period of the debt, 5 years, because it's going to be repaid at a premium of 10% after 5 years. So basically what's going to be repaid will be 22%, 22,000, which is the original 20,000 nominal value. For minor discount, it's the nominal value that has to be repaid plus 10% based on the nominal value. Okay, so the 10% is not based on the cash that's received. It's 10% nominal. So we've got to pay 22,000. So at 7% per annum, the effective interest rate, that will increase the 18,966 up to 22. We were asked Well, what's going to happen at the end of the first period? Well, we've received 18,966. We have to charge that, the 7% nominal. Okay, 7% effective interest, sorry, the 7% effective interest, which is based on the 18,966. So that is linked to that. Then we have coupon interest, 800. That is based on the nominal value. Okay, so that's going to be based on the 20,000. Give you 800. Got 19,494. Okay, if you want to do this in your dreams, then you can work it out for the remaining 5 years, and you'll end up with a closing balance of 22,000. Okay, any questions just on how you're going to be dealing with liabilities, and it's being worked at, back to the element here, amortized cost. Okay, so any question that comes up with amortized cost, that's the way you would
No questions.
work
It's
it
okay.
through. No questions. Okay, good. That's the easy one. But even if it's easy, you can still go. Right, here we have I'm just wondering if this was still recording. Yes, it is. Can't see the green band sharing my screen. Good. Still doing that. You can see it, and you tell me very quickly if you couldn't see the screen. Fine. Right, compound instruments. What do we mean by compound instrument?
Written here.
It's
And equity component.
Yeah, that's what it's saying here. But what on earth does that mean? Well, the most common one of that is going to be a convertible debt. Okay, convertible debt into a loan. Sorry, a loan into equity. Okay, that will be the basic one that usually comes up. So there's a liability element, the obligation to repay cash, but there's an equity component that you have an obligation to issue a fixed number of shares. And it's really a case of trying to work out the issue of the instrument, what is the liability and what is the equity. So you start dealing with split accounting. Calculate the liability component and the equity component. Sounds complicated, but it's relatively straightforward. The liability component, because it may be over 10 years, let's say, is going to be the present value of all the cash payments discounted using the market rate for non-convertible bonds. Then the equity component is the difference between the cash you received on day one and the liability component at the issue date, which is discounted present value of the discounted cash payments that will have to be made. Okay, so when you've worked it out, then the liability reverts to amortized cost. You know how to deal with that. But the equity component is not remeasured. You just put the equity component onto the statement of financial position as a separate element of equity. Okay, you don't put it in as a share because the share has not been issued yet. It's not been converted. Okay. So, compound instrument example. 5%, okay, nominal rate, coupon rate, Convertible loan is issued for 5 million. 3 years for cash of 5 million, or may be converted to equity. Market rate for loans with no conversion is 8%. So what's the 8%?
Discount rate.
The examiner's going to give you a choice. And you can see here, you've got a discount rate of 5%, and you've got a discount rate of 8%. 5% is the nominal value. 8% is the conversion option, which you might say, well, okay, that's the effective interest rate. You might say that. Right, so split between equity and liability, and then show financial instruments for the year ended 31st December is going to be on the basis of, what's the basis? Remember, amortized cost. So what we've got to work out is what's the financial liability, the initial present value of the cash flows counted using the market rate of interest. Okay, effective rate of, but it's going to be the cash flows. So in the first year, you're going to pay interest, and that's 5,000 at 5%, which will give you a present value of 233. Now, with the factors, the examiner will tell you the factors, which is what you've got here, but you've got to choose the right one, which at the moment is the 8% that we're dealing with. Okay. Or you may have to calculate it out using the appropriate formulae. If we have an interest rate in the second, 150.86215, then always remember that you're paying it back. But when you pay it back, also going to be interest. Pay it back at the end of the year, you're going to have to pay the interest for the year. So it's 5,250 at the factor of 0.79, and that will give you a total liability of 4,595, which means that the equity is the difference between the two. All right, so it's relatively straightforward once you've got through all the terminology and everything. So what's going to be the extracts? Well, you're going to have a finance cost, and that will be at 8%. It will be at 8% of the opening balance, 4,595. What's the 4,595? Quickly tell me, stop me. Here we go. It's going to be the liability element. It will not be 5. Okay, if this was a standard liability financial instrument loan, it will be the 5, less any discount or costs. But here, we're dealing with a mixed instrument. So we have to work out what is the liability element, 4,595. So that becomes the opening liability is 8%. Finance charge of 368. What's the difference between 5,000 and 4,595? That will give us the 405, which then becomes the conversion option, separate heading within equity. What's going to be the non-current liability? measure the amortized cost. So we're going to work that out on the basis of the opening debt, 4595, not 5, okay, because we got a compound instrument and we've stripped out the equity elements. The debt is 4595. What's the debt percentage? Well, we've got a 5% nominal rate, but an 8% effective interest. So we add to that the 8% effective interest. We deduct from that, I think because it's off somewhere else, back. Good. We deduct from that the nominal rate, the coupon rate, 5%. But notice it's 5% of 250. Okay, because you're paying back if it does not, if they don't exercise the option, you're going to be paying back 5,000 at the end of the year. So it's either 5,000 cash or converted to equity. All right. So you'll take 5,000, or sorry, you'll take 5% of the 5,000. 5,000 at 5%. Okay, so it's dead easy to mix up in terms of what the rates are, what the interest rates are. That will give you a convertible loan of 4713. Any questions?
There is one question.
Only one.
Yes,
Go on then.
yeah. In case when we have this instrument and when the discount rate becomes, for example, 10% from the second year, what should I do with it?
Changes. It won't. You're not going to have any changes in interest rates. Okay, it will be fixed interest throughout the. How many years are we doing with this? Was it 3 years? Yes, it was. Yep. Okay, just a little bit of fun. If I've got 4713, what's the interest adding on to that? And I've just reached for my calculator as well. Yours. We've got 4713. Oh, 4713 times 8%. Yep. 377. Less to 250. Okay, plus 73. Yeah. Doing this as well as I'm doing it. Maybe you're ahead of me. 377. Minus 250. Or, of course, it would be 4713 plus 127. To give you 4840. We have 480 plus, that's 8%, yep. 387 minus 250. Again, you can do it quickly. So we go plus 387 minus 250 give you 4977. Why 4977? Not 5. Should it be 5? Should it be 4595? 4977 because you're working to 1 or 2 decimal places. Okay, and it won't be 8% effective interest. It might be 8.01763, whatever. But the examiner's given you 8% as a round figure. So there's a little bit of rounding difference in there to work it out. If you use the exact effective interest rate, as I say, it's not going to be 8%. It just makes it easier for the calculation.
Yes, but
sorry?
Yes, but my question is different. In case if the market value of the rate changes,
Yeah.
if it changes from 8 to 10%, what should I do in this case?
No, it's the effective rate, and you're not going to have that in the.
I'm not going to have that. Okay.
No. You wouldn't even get that in SBL.
Okay.
Okay, because effectively what's going on is that you are taking that point where you're applying the effective rate of 8% because you want to bring it up to 5,000 at the end of 3 years. Okay, so if you suddenly change the 8 to 10% second year, you're going to end up with more than 5. So it's based on at the point in time.
I see. Okay.
If you take a lease, the lease could be over 10, 15, 20 years, for example, but you've always got the rate implicit within the lease. And that will always stay for the entire period. It doesn't change.
It can change in case the residual value changes.
I was just going to say that if the residual value changes and you're dealing with this, like for example, if you're dealing also with it in the act of a what's the word I'm trying to think of, dismantling asset.
Yes, or just buying out with the fair value.
If that rate changes, you recalculate
okay.
everything. But here, you're going with you've got to repay 5,000, so it will stay the same.
Okay, I see. Okay, thank you.
Yeah, so you're coming back to 4977, which is effectively 5. Got a rounding element coming in there. So again, it doesn't matter about the equity and the liability element. You're always coming to the fact that you've got to repay 5, which is what the question was here. Where it's gone. Yeah, you're going to repay the cash of 5, or it may be converted to equity. So if it's converted to equity, then you're going to be debit cash, credit, equity, right? What happens to the 405? Lenders don't really say. Equity element. So every single time I come across this, it's just been left as part of the equity. As part of the equity element, it does not get transferred into share capital. It's not share capital. Share capital is something specific that's been issued. It stays there until the company wraps itself up. Right, financial assets. So the liability is probably the easiest one if you can remember. Right, investments, shares, as as a first financial. You have a choice. Fair value through P&L. Okay, if you've got an investment in share and equity, you could be an investment company you're buying and selling. You're holding for short-term trading. That's the default position. Deemed that you're going to be trading in that investment unless you opt to the fair value through other comprehensive income. Okay, so if it's not held for short-term trading, you designate it as fair value through other comprehensive income, you cannot change your mind. Irrevocable. Can't revoke. Once you made the choice, that's it. Okay? So the initial is always going to be at fair value, and then you revalue with the gain or loss going through statement of profit or loss. If it's going to be fair value through other comprehensive income, then it's at fair value plus costs is the initial recognition. And then you revalue each reporting date as normal, but the gain or loss will go through other comprehensive income. It's not shown as a separate trading profit or loss. Okay, if you're putting it through other comprehensive income, then you show it in equity element through the statement of changes in equity as a separate change. Right? So you just got to determine what the client's going to be doing with it. All right, so if we look at the example, we've got 21st of November, equity investment of 6,000 shares, the cost of $2.70 per share, plus the transaction costs. Shares have a market value, so they've gone up by 25 cents. In the 6,000 shares, and you can work out that the fair value increase is going to be 1,500. Yeah. Okay, but what's going to happen? An equity investment. So there doesn't appear to be any statement that it's not going to be through anything other than profit or loss. Okay, so the gain on the investment starts at 6,000 times 270. It will then end at 6,000 times 295. So the pure gain is going to be 1,500. Transaction costs not added to the fair value. They're written off directly to the profit and loss. Okay, the impact will be the same, but it's a case of looking at how it's classified. All right. Okay, so that one, very quickly, what if had been at fair value through other comprehensive income? What would you have?
I would recognize it with a sum plus transaction cost. 2.7 plus
You'd have
transaction cost.
6,000 shares at 2.95, yeah, right, plus transaction cost of 3. Okay, so that would give you what you're dealing with, and then that would be looking at 6,000. And what was the? Oh, sorry, no, that's the closing. It's what was the opening? 270.
70, yes.
Yeah, and 6,000 at 295, and that will give you the movement in the other comprehensive income. Yep. So what is the movement in the other comprehensive income? 1,500 less 324.
1,176.
Okay, good. As I say, it's just the way you classify what is going. Right, investment in debt. So this is looking at it from the other side where we're looking at the liability. Now we're looking at the business where that liability has been purchased. Okay, investment in debt equity, or debt instrument, not equity, debt instrument. So it can be amortized cost, it can be fair value through other comprehensive income, it can be fair value through profit and loss. And it all depends on what's referred to as the business model. Okay, you should be able to, you should recognize this straight away. It's going to be at amortized cost, as with the liability, going to hold the asset till maturity. Okay, so if I've got a 10-year debt, I intend to keep it for 10 years. Okay, so the contractual terms are repayments of principal and interest of the principal amount outstanding. So it will be that, it may well be that the principal is going to be repaid at the end. So you've got interest over the period, principal at the end. If it's going to go through other comprehensive income, then it's going to be a mix. Business model is not going to be to hold purely until the end, but it will be about collecting the contractual cash flows, but the asset may be sold. Okay? If it's not going to be amortized cost or through comprehensive income, then it's going to be, it's not exactly a default position, but it's the remaining position. Treat it through profit and loss. Okay, so if you wanted to treat it through profit and loss anyway, then you wouldn't classify it at amortized cost or through the comprehensive income. Okay? So you go with the wording. Of what the examiner tells you to determine whether it's going to be an amortized cost or it's going to go through other comprehensive income or it's going to go at fair value through the profit and loss. Right, so let's just quickly go through some examples on this. 1st January, Tokyo had 1 million 5% bond, bought it for 95,000, so it's got a 5% discount. Acquisition cost of 2,000. Interest is received annually in arrears. It will be redeemed at a premium of 5,960. over the nominal value at the end of 20x3, x1, x2, x3, 3 years. The effective rate of interest is 8%. The coupon rate is 5. On the 31st of December, the fair value was 110. On the 31st December x2, it had decreased down to 104. So, with that, how would you treat it if the bond was held until redemption date? What methodology are you going to be using?
Amortized cost.
That will be AC, amortized cost, yeah. Once you've got that, you've effectively, hopefully, got the marks for it. Tokyo may sell the bond, might sell the bond, if the possibility of an investment with a higher return arises. Okay, so if a new bond is issued and the new bond is at 10%, then they want the money to buy the new bond. They will sell the current bond. Okay, so how would you deal with that?
Fair value through other comprehensive income.
That will be the other comprehensive income. So as I said, read and you can very quickly pick out which one it is. Item C, it's not a case I'm not going to do A, I'm not going to do B. The case is that they make a decision that they're going to trade the bond in the short term. So that will be fair value through profit and loss. Okay, the clue there, they're trading the bond. Okay, so if you're dealing with the amortized cost basis, then we're dealing with exactly the same. In terms of the first year, initially recognized as fair value plus transaction costs. Okay, so the fair value of 95 plus 2. Okay, so bought 100,000, 95, so 95 is its fair value. Acquisition costs of 2. As it's not going through P&L fair value, you add the acquisition costs. Okay, so we've got 97,000. 97,000 at 8%. We pay 5,000. Why 5,000? Because we got 100,000, 5% bond. 100,000 nominal, 5% is going to give you a 5,000 interest. So you got 99,760, and you're working all the way through. And that will bring you up to 105,960 at the end. All right, what does the 105,960 relate to? That's going to relate to 100,000 nominal value for the bond, and it's being redeemed at a premium, which is based on. That will give you 105,960. It'll be based on a premium. The premium is based on the nominal value, not fair value. So that gives you 105,960 exactly. Okay, if we then look at, we've got in the second option was doing it through other comprehensive income. Okay, so again, we start off with the 95. This is going through other comprehensive income, not dealing with it as fair value. But because it's going through comprehensive income, going through fair value at comprehensive, not amortized cost. So we've got a net value of 99,760. Okay, what's the fair value? We are told that the fair value at the end, that was somewhere up here, wasn't it? The fair value is 110,000. So if the fair value is 110,000 compared to the net after the interest received and the interest charged, fair value adjustment is 10,240. So that 10,240 will be recognized within the other comprehensive income. Again, you've got a risk that you'll just automatically say, okay, bought forward 97, closing at 110, thank you very much, 13,000. You're wrong. You're not taking into account the interest received and the interest charged. So we start with 110,000. Okay, how much we're going to charge?
Interest calculated on the basis of amortized cost.
Same again, the 7981, good. Okay, 5,000, 112, it's now worth 104. So we've lost 8981. Okay, so we bring forward 104, and the 8219 again is going to be based on the amortized cost approach to it, not on the fair value. If you're looking at the nominal values of it, you still get the 5 because that's at the coupon rate. And we get 107,219, and we have 105,960 as the fair value. So we've got another loss of 1259. Okay, looking at the movements, the fair value should be 107, but it's not. Okay, a little bit more tricky because you've got to remember that the interest rate is going to be based around the amortized cost. If that question comes up, you've got to be working out what the amortized cost interest rate would be, get the net, then comparing the net amount with the fair value, and that will give you the gain or loss. If we're dealing with fair value through profit and loss, okay, then it's 95,000. Why? Because the two will go expense directly to P&L. So anything that relates directly to fair value through P&L, the transaction costs are separately charged. Okay, if it's not P&L, if it's amortized cost, or it's going to be through other comprehensive income, then you add the transaction cost. Easy way of remembering it. First year we had interest coming in of 5,000, 5% of the 100,000. That will be recognized directly in the profit and loss. Okay, as it's at fair value, the asset would be revalued to 110. In this case, you're going from 95 up to 110, so you get a gain of 15,000. Okay, this is directly fair value through profit and loss, so you don't have to concern yourself. Excuse me. You don't have to concern yourself with thinking about it in terms of amortized cost. Great fair value exercise. Okay. Any questions?
Questions?
Recognition? You recognize it when the obligation in terms of financial liability, so when it's been discharged, cancelled, or it just expired. Okay, so if you've got any difference between what's been transferred and the carrying amount, transfer it directly to profit and loss. Financial asset, contractual rights expire, or the risks and rewards of the asset have been transferred to another party. So again, any difference between the carrying amount and the consideration is just going to go through P&L. You can akin that to playing around with bad debts. Okay, so you have a bad debt. Receivable is a financial instrument, not going to be paid. You've got no longer any contractual rights to the cash flow. Whatever the asset was, whatever the receivable was, is going to be written off directly to the profit and loss. Factoring. I'm just looking at the time on this. All right, I'll let you read through what the factoring element is, with recourse or without recourse. If you're dealing factoring with recourse, for example, you sell your debts to a bank with recourse, then the bank can give you a debt back that's gone bad. You have to deal with the bad debt. Okay, so control has not been transferred to the factor. If it's without recourse, the risk and reward of a bad debt has been transferred to the bank. They cannot get it, they cannot give it back to you. In that case, you can de-recognize the receivables balance because you've got control over it. Whereas with the recourse methodology, you're not going to de-recognize the receivables because some of it may come back. Therefore, you treat the receipt from the bank as a loan with the receivables as collateral to the loan. Without recourse, no collateral because they... Okay, so you can work through that. Good. Quick question time.
Oh, questions.
Sorry?
No questions, examples.
Yeah, question time. Oh, sorry. I'm thinking, okay, example time. All right, terminology. 87 to 96. 276. Let's go. We've only got left in the timing here. So let's go with the study text. And we will go straight to question 7. Reasonable. 276 is going to be a section B question. Yeah, okay, it's a mix. A little bit of calculation, a little bit of debt factoring in there. See if you can sort that out. And a little bit of convertible debts and various other. All right, so if you'd like to work through 276 all the way to 285 there, 276 up to 280. I forgot we've got 281. Do 281. 281 to 285 on screen. That will be page 82. Okay, 281 to 285. Work through that. Review that, and that will.
D.
That's number 281.
281, yeah.
Okay, all right. I was thinking all of them. All right, carry on for 282. You're right in terms of 281. All of them. Cash item in there. Guess, have a look. A, B, C, or if it's a liability element, and it's a convertible loan, and what are you going to be using? You're going to be using amortized cost. Okay, so what's the balance brought forward? 28508 convertible loan notes. We start with 28508. What's the effective interest rate. And so add to that 851. Yep. Payment is 20. That will give you 28.59.
59.
So what would the charge? We're dealing with the finance cost, interest in the statement of profit and loss. If it's going to go to the P&L, then that's the effective interest rate charge, not the coupon rate. So what did we issue? We issued 10 million. Yep. What were the issue costs? 400,000. So that will give you the initial value. There is a 9,600,000, and that will be at 8% effective interest. 768. Wait for.
Anybody here?
I am there. I'm waiting for your answer.
284, 1 million D.
I think B, 0.1 million.
We've got a difference.
Dividends.
Okay. The answer is
1
actually
million.
B. You're partially right. What is the 1 million?
It's the difference between the previous market value and the current market value.
Okay, so that's the fair value gain.
Yes. And
But it's asked you what income should be recorded in the statement of profit and loss in relation to the equity investments. So what other income is going to come in? Dividends.
yes.
Dividends received will be income, sundry income into the P&L, investment income into the P&L. But if it's the equity company issuing the dividends, paying the dividends, then it's not going to go through P&L. It's going to go through the statement of changes in equity. Okay, so here it's income from investments, and that is going to be 1 million shares at 10 cents. Okay, so that will give you plus 100,000, 1,100,000. The more you practice, the more you pick up on these subtle little, can't really call them traps, but subtle little dead ends. Okay, good. 285. The last one.
First capitalize, second no, third capitalize.
Yeah. Capitalize, no, yes. Okay, why? What did I say earlier? If it's going to be fair value through profit and loss, then you charge the cost directly to the P&L as a separate charge, separate cost. Yep. Everything else, add it, so you capitalize it. So amortized costs and fair value through other comprehensive income. Good. Right, guys, we're up to 9 o'clock. So let me just recap in terms of what we said with the timeline. If I can bring it, where's the timeline on there? Good. Let me just whiteboard. So we said tomorrow, which is the 20th. Yep.
Yes.
Then I'm going to be looking at consolidation. Just give you a couple of consolidation questions. Work through and look at the mechanics on that. Okay. We then got seminar on the 24th, and that will be, if you like, catch up. Maybe a bit of consolidation, maybe some of the other areas that we've not looked at, or anything that you guys want to refresh. All right.
Yeah.
Then after that, you'll get the mock exam. And I will mark the mock exam. So I need the mock exam. To be able to mark it, I need the mock exam. Did I say the 30th?
Yes.
Okay, because I'll give you feedback on the mock exam. We'll come back. Back, feedback, WhatsApp, hotel, dance. I'll give you the feedback on the 1st of the 12th. Okay, same timing, all at 1800. Okay, so again on the 12th, the feedback may be half an hour, maybe an hour, but we can do feedback plus questions from you guys. Okay, just anything else that you're not sure of. At this stage, should be trying to work through as many questions as you possibly can. And I strongly recommend that those questions are going to be taken from section C, the long form questions. Okay, and in particular, if we go to the revision kit, section C questions. Okay, so these are the longer form questions you can see here. 20-mark questions. I would concentrate on the interpretation questions. Okay, how to interpret financial statements and cash flows. Okay, because it's quite difficult. It's not sort of a consolidation where you can paint by numbers and plot the figures in. Really a question of working through, but soaking up how the examiner explains the reasons for the changes. So if you read his article, Tell Me a Story, then that will certainly give you a good idea. Okay, but the best way of dealing with it is to see how he does it. See what he says in particular circumstances. So if those circumstances arise again in the exam, or when those circumstances arise in the exam, you will be able to answer the way the examiner would answer. Okay?
Okay.
So enjoy whatever you're getting up to tomorrow, work or otherwise. And
I have a question about statement of cash flow, because we're not talking about this chapter, but where it appears in the exam, in C or B?
well, it could be A, B, C, or D, but there's not a D, so it won't be D. Okay. In the A or B, might be asked to calculate, for example, the changes in the working capital.
Okay.
Okay, so you might have investments in assets, etc. So you might be asked to calculate the net amount of one of the sections.
All
right, or in section C, you'll need to calculate the whole cash flow. Or in section C, you may have to analyze two positions on a cash flow. Compare the two cash flows. So that's where it's likely to come. So it could come anywhere. Get the whole cash flow in section C, plus analysis of the cash flow. Okay, but you'll get an element of the cash flow in A or B.
Okay, good.
Or not, as the case. Hopefully it's good for you guys because you understand.
I think it will be easier than, but we'll see.
Don't get too overconfident.
Maybe consolidation will be much more interesting.
Yeah, it's always interesting. Right. Okay. Well, we'll see how interesting tomorrow.
Okay. See you
Okay,
tomorrow.
gentlemen, back online at 6 o'clock tomorrow.
Bye.
Okay, bye.
Good. Thanks. See you then. Cheers.